Okay, fun seekers, it's fall 2024 and we're ready for our long march. And unlike Mao Zedong's long march towards communism in China, we're going to do a long march into the heart of capitalism. What do you think about that? We're going to discuss stocks. Oh, what an unfortunate term. I don't like the term stocks. I like to think of businesses. Yeah, businesses. But unfortunately, everybody uses the term stocks. So let's start off with a couple of great quotes here from Will Rogers, a humorist from the early part of the 20th century. Don't gamble, take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Very good advice. You see, 100 years ago, the entire culture had been rocked to its core, to the foundation, when the stock market was clobbered in 1929 and 29, and then ushered in the Great Depression. But it really wasn't the stock market crash that ushered in the Great Depression. There were other things that the Federal Reserve Bank and the Congress did that were really stupid. But it was the beginning. It was the beginning of a very difficult time. And so people did not trust the stock market, the crooks on Wall Street, for almost 2 generations. Hard to believe. And then a cute joke, which I love to use. How do you make a small fortune in the stock market? Well, it's easy. Just start with a large fortune and you can make a small fortune. Yes, stocks are risky. But we're going to see that stocks are where it's at, folks. If we're looking for long-term growth and the world doesn't end, this is where we want to be. So let's take a look at slide number 2. What are stocks and where did the term common stocks come from? Well, it started with the first corporations' endeavors to explore the new world 400 years ago, and the investors were shareholders in common, which means every person who has 1 share gets 1 vote. And if you had 10 shares, you get 10 votes. And obviously, if you have 50% plus 1 shares, you're in charge. Stocks represent ownership in a corporation. And I don't even like the word corporation because that has its negative connotations also. Are corporations people? Well, obviously, they have as many rights as sometimes a lot more, because they have a whole lot more money. But no, I like to use the term business, right? Equities. Equity means ownership. So you'll hear people say, you got your money in the market? Yeah, I'm in equities. Or no, I got my money in cash. I'm on the sidelines. I got the money in the bank, in the CDs or money markets. Stocks, corporations, businesses enable investors to participate in the profits and growth generated by the business enterprise. But one thing we don't discuss are the fact that stockholders are limited liability owners. What does this mean? Well, you can only lose your investment. If you buy 1 share of a company that's selling for $100 and the company goes bankrupt, your share becomes 0. But they can't come after you after that. They can't say, oh, you know what, the corporation owns this many debts, and so you have to pay us more. That's not the case of a partnership or a sole proprietorship where you and the business are one and the same. Now, obviously some people use this ability or try to use this ability as a tool to get rid of debts. And well, some of them have run for president. One was a president, 2 were presidents. But no, if you take an introduction to a business class, you'll learn about different business structures and legal structures. And sometimes if somebody tries this shenanigan to hide the debts in a corporation and run away with the assets, it's called piercing the corporate veil. The courts can say, no. You use the corporation as a sham to get rid of your debts. And they can pierce the corporate veil. Now, why would we invest in stocks? Well, stockholders receive optional payments of earnings. They're called dividends. You can think of them like an interest payments. In fact, we often do when we compare stocks with bonds, which are loans. Bonds pay interest, stocks pay dividends. But unlike a bond where the interest payments are mandatory, the stockholders may or may not receive dividends. Now, some companies have been paying dividends for over 100 years, right? And some companies don't pay any dividends. So that's why we say they are optional payments of earnings. And then the item that most people key on are the capital gains, also called capital appreciation. If the business does well, markets do well, the value of the business should rise. The rise in your value of your stock should rise. Now, it's not always a one-to-one correlation. It doesn't always work that way, but that's how it works. And typically, if the company does well, you're going to see your stock price go up. Of course, if the company doesn't do well, obviously you could have capital losses. And contrary, as we write at the bottom, as we read at the bottom, contrary to what many people believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper. Well, they're not even paper anymore. It's all electronic bits that people trade each day. No. They represent ownership in real businesses. So if you buy one share of FedEx and that truck drives down the street, you can look at the right front tire and that one of those lug nuts. That's your because these corporations are huge, immense, global in nature. So yes, we are participating in the success or their lack thereof of huge businesses. Now, some are not that big, and we'll learn about the different sizes, the different what are called market capitalizations of businesses, of stocks, in a future presentation. But let's now, on slide 3, take a look at the historical performance. Over the long term of modern finance, and we won't get into why we call it modern finance, but it has to do with technology and history and the like, the Industrial Revolution. The return of the stock market has measured by the Standard & Poor's 500, which we'll discuss in a couple of presentations. We've already been using it, right? We were discussing mutual funds and the like. Has averaged approximately 10 to 11% annually over the last 90, 100 years. Now, it's actually better than 10%. What I do is I tell people 8, 9, 10% because I don't want to get their hopes, their expectations too high. I mean, if I get 8%, I'm a happy man. I'm a very happy man. But it's actually been better than 10%. It's actually been better than 10%. But in any one year, it is unlikely that the return will be 10% or 11%. No. As we saw in chapter 1, it's a very wide deviation. The return has varied from a high of 53.8% to a low of minus 43.4%. And 2008 was one of the worst, 38.5% to the downside. And in any given year, there has been about a 1 in 3, 1 in 4 chance of a down market. So you really don't know what's going to happen next year, as we discussed in detail in chapter 1. We just have to be prepared emotionally for when that happens. And we're going to learn that we can use that volatility to our advantage by simply continuing to invest and not panicking. And if the world does end, it doesn't matter where your money is. There was a huge exception, the major exception was the great run-up from 1982 to 2000, where the stock market went in two directions, up and way up. And then stocks went down 3 years in a row. So if you saw those 3 years in a row down, you think, oh my goodness, but then of course it's come roaring back since then. So we must take a long-term perspective. And again, as we've said over and over again, there's an intellectual part. You take a look at how well stocks have done versus bonds versus gold versus short-term investments. And you say, well, obviously I want to invest in stocks. But then when you have a 2008 come along, or 2001, 2001, 2002, and goes down 3 years in a row, no mas. Then you emotionally say, oh gosh, I don't know why I got involved in this. So we must take a long-term perspective. So again, here's the slide. Slide number 4 is is definitely it's like an argument toward investing in stocks. But remember, warning, logarithmic scale. We take a dollar back in 1928, and we see that that dollar by 2023 has turned into $7,800. Bonds have done pretty well at 83. They've beaten inflation handily. Treasury bills have just barely beaten inflation. So this graph, I think, is a pretty darn good argument for investing in stocks. But remember, it's a logarithmic scale. These little squiggles are not little squiggles because we're using a logarithmic scale. They look small, but they are not. And if you go back to the chapter 1 graph where we showed you the actual, exponential graph and arithmetically, see, because as we said, this is, not 1, 2, 3, 4. It's 1, 10, 100, 1,000, 10,000. So you have to be careful with these logarithmic scales. But I mean, really, doesn't it show you that it's best to invest in stocks over the long term if we don't panic? Yeah, I think so. Slide number 5. And this again from chapter 1, where we saw that if we take a very long-term time horizon back to the dawn of the industrial age, we see that stocks have just clobbered everything else. And if any of you really want to invest in gold, go right ahead. But notice that gold, over the time, it hasn't even beaten the bank, the savings accounts. It hasn't even beaten cash investments. So, I'm not a big fan of gold. We'll discuss it at the end of near the end of the semester. I had one student who, from the beginning of the semester, he just couldn't wait. He wanted to talk about gold, gold, gold. And I kept saying, we'll get to that. But look at what, do you really still want to invest in gold after you see this graph? So what he did, he bought me a certified grain of gold. And I have it hung up over on my dresser over there. So I think about him when I think about people who want to invest in gold. He actually didn't make it through the whole semester. He dropped because I guess he was upset that we were spending so much time on everything but gold. Slide number 6. It hasn't been a smooth ride, though. It's a bumpy ride if we invest in stocks. If we look at these rolling 10-year periods, we find that there are definite cycles that we're going to go through. And it's not a guarantee for what's going to happen in the future, but this is what's happened since the modern financial world. And why do I'll diverge a bit. How are we doing for time? Not bad. Why do we call it modern finance? Well, because of technology. And the one technology that is the probably the poster child for the industrial age is the steam engine. Yeah, because before trains, most goods were carried by water. And, goods are still carried by water, and that's still the cheapest way to carry goods. But trains are pretty darn close. And when you can send goods across the country, then you don't have to buy stuff locally. You can get your shoes from St. Louis, which was where shoes were made for much of the 20th century. You can get your cereal from Battle Creek, Michigan, where Kellogg's is based. And so that really changed the world, the industrial age. There are so many other inventions also, communications and the like, and electricity and different and energy sources and energy. But it was the steam engine, the locomotive, the trains that really changed the world of the industrial age. So that's a bit, okay, I diverged. My apologies. Let's now take a look at the rolling 10-year period. So this is, you put your money in, 1 year, and then 10 years later, how did you do? Well, if you started before the Great Depression, you actually had negative results. You put your money in 10 years, it was less than what you put in. But coming out of the Great Recession, coming out of World War II, the stock market went in two directions, up and way up, and we had rolling 10-year periods that almost touched 20%. And what did you hear people say here? Ooh, is it too late to get in? And when you hear that, dear students, The answer is almost invariably yes. It's too late to get in. Now's the time to be selling, or at least buckling your belts and being ready for a rough ride. Because then we had the 1960s where stocks were very expensive, and we had some serious turmoil culturally, civil rights, women's rights, gay rights. My mother had a hard time with that one, but she said, "Why don't they just be quiet about it?" The Vietnam War, Watergate, the first oil crisis, 1973. Look it up. Type oil crisis, 1970s. You'll see pictures of cars, a mile-long line waiting for gasoline. But it was the hardest thing that hit the 1970s was not only in terms of stock market and the economy, was not just because of the stock market being overpriced and because of all the other problems. It was the baby boom generation. Coming out of World War II, it was your patriotic duty to have as many children as you could because we are going to beat the Ruskies. So it was unusual. It was not unusual to have 4, 5, 6 kids in a family. If there's only 1 or 2 kids in a family, obviously there was something fishy about that family, probably communist sympathizers. And sure enough, the baby boom generation came of age, and I'm one of them, we all had to have jobs and houses and cars and shoes, and it was a very difficult time for the economy. And you had a rolling 10-year period where you just barely eked out a gain. Brutal bear market, 1972, 1973. And what did you hear people say here? What market went down 50%? Ooh, is it too late to get out? And when you hear that, I want you to remember this. When you hear that, it usually means, yes, it's too late to get out. Now's the time to be buying, right? Now's the time. But who wants to buy after the market's fallen 50%? So we come out of the 1970s, and it was the 1980s, globalization, miniaturization, computers, internet. Oh my goodness. The stock market went in 2 directions, up and way up, and you had rolling 10-year periods that almost touched 20%. And what did you hear in the late 1990s? Blue skies, productivity gains as far as the eye can see. Ooh, is it too late to get in? Yeah. 2000, bang, 2001, 2002, stock market went down in 3 years. The internet bubble burst. The internet part of the stock market went down over 90%. The technology, as measured by the what's called the NASDAQ, which we'll talk about in a couple of sessions, fell 80%, and the Standard & Poor's 500 fell almost 50%. And then we had the housing bubble. One bubble after another one. And sure enough, you have to go back to the Great Depression to see rolling 10-year periods that were negative. And we didn't call it the Great Depression 2 because it wasn't a depression, thank goodness. I mean, for all, you don't call economics the dismal science for nothing, but they did it. They were able to avoid a second depression. We called it the Great Recession. And sure enough, in 2008 and 9, what did you hear people say? Oh, is it too late to get out? Emotions, folks, were not rational. As we'll see, we're going to have a whole chapter devoted to, are we rational? We aren't. We are not rational. And sure enough, that was the time to get in. And the stock market since then has done pretty darn well. Now, notice the last few years. Do I think it's going to do this exact same cycle where we touch almost 20%? I don't think so, but that doesn't mean I'm right. It doesn't mean I'm wrong. That's why they call it the future. All I know is if we take a long-term perspective, capitalism may be just the worst economic system ever developed, except for all the others. And so I have tremendous faith that the next 20, 30, 40 years are going to be the most prosperous years in the history of the world. Technologies are coming down that we just thought were science fiction. But you just don't know. That's what they call it the future. We could have another COVID. We're probably going to have another COVID, which might be worse than the first. We could have a meteorite that could destroy much of the world. We could have tsunami, a nuclear war, die in our own waste, disco could return. And I know you think I'm silly about that, but you didn't live through it, many of you. You didn't live through a time when men were wearing high-heeled shoes. Well, they called them platform shoes, but it didn't last very long. So, as I said, I'm very optimistic. We'll see. And of course, in 30, 40 years, I won't be around, but you will be. Many of you will. And I hope you can say, thank you very much, Payano, because I invested prudently, wisely, with an eye toward long-term growth of capital and income. And now I'm doing pretty good. We'll see. We'll see. Slide number 7. Historical performance continued. Traditionally, close to half of the return from stocks was from reinvested dividends. You see, stockholders used to expect 4 to 6% in dividends each year. That was as much or more than bonds returned in interest, since stocks were considered much riskier than bonds. Now, between 1936 and 2008, the Standard & Poor's was paying about 3.8% on average over those, 60 years or so. 70 years. But dividends fell to less than 2% and even 0%. You see, in 1980s, 1990s, capital gains were what people wanted. Now, there was a few reasons for that. So between 1997 and 2007, the S&P dividend averaged about 1.5%, which is about what it's paying now. It's very low. Now, that doesn't mean some stocks are not paying more. Some are paying more. And we're going to certainly see some of them. And we're going to see a lot of stocks that don't pay any dividends. Yeah. And the reasons were varied. Dividends were taxed at a higher rate than capital gains. Well, that's not true anymore. People wanted the business to invest the company. They wanted the business to reinvest the earnings for growth instead of distributing it to the investors. Don't give me the cash. Use it to make the business stronger. Stocks were no longer considered riskier than bonds. Well, there were some very popular books in the late 90s. One of them was called Dow 36,000. And when it came out, I knew, okay, Dow was around 11,000 or 10,000. I knew, okay, we're going to have a crash. I don't know when, but it's going to happen. I mean, I believed then, and it's already happened, that the Dow would hit 36,000 eventually. But I didn't think it was going to be in the next couple of years, which this book was pushing. Savings accounts were also paying less than 2%. And as some of you seen, now some of them are paying much more, but some are still paying less than 2%. And of course, people lost track of their senses and bid up the prices, and there was something to be said for that. Ooh, is it too late to get in? 1998? Yeah, it was. Slide number 8. This is a graph that shows you the yield on bonds which paid interest versus the yield on stocks paying dividends. And we see back in 1960s that the stock market was paying about 3.8%, which was the historical average, and bonds were paying a little over 4%. This is the 10-year Treasury bond, as I remember. And then what happened? Well, we had the 1970s, which we said was a very difficult year for the economy, the baby boom generation coming of age, and it sparked a period of inflation. And inflation is the worst nightmare for bond owners. So bond investors wanted to have higher interest rates. So the interest rates started creeping up and up and up. And we saw the dividend creep up. Why? Because stock prices went down. And so when you divide the dividends by the price and the price goes down on the denominator, that pushes the quotient up. But then the Federal Reserve Bank, Federal Reserve Chairperson, Paul Volcker, was pegged by President Jimmy Carter. And yes, we did have a president named Jimmy. He's still alive. God bless him. He's outlived his wife. It's very sad, but he's still with us. He appointed Paul Volcker, and he said, Mr. Volcker, we need to kill this inflation. What can you do? Well, Mr. President, we can do it, but it'll probably cost you your election in 1980. And to Mr. Carter's credit, he said, you do what you have to do. It's exactly what President Biden said to the Federal Reserve Chairperson Jerome Powell. He said, you do what you have to do. You have your job to do. You can't worry about the election, about my election. And so what they did, they ratcheted up short-term interest rates. We're talking about in chapter 1, right? Short-term interest rates. To the point where the prime rate hit 22%, mortgages were 17%, but just for a short period of time, caused the worst downturn since the Great Depression. And sure enough, though, broke the back of inflation. And it did cost Mr. Carter the election, along with the Iran hostage affair. And interest rates started coming down. And as prices on stocks went up, the dividend yield started coming down and down and down. For bondholders, oh my God, this was a great time, because when interest rates come down, bond prices go up, and we'll discuss that later on. Until finally in 2000, when you heard people say, ooh, is it too late to get in? The dividend yield hit 1%. And that was the bottom, right? That was the bottom of the top of the stock market, the bottom of the dividend yield. It's never hit 1% again yet. And then that's when we had the major downturn of 2000, 2001, 2002. But you can notice that bonds still started coming down. And here, look at this, 2008. Very unusual. The yield on stocks went above the yield on bonds. That's just so unusual. And that was the time he should have been grabbing stocks with two hands. And I'll never forget one of my clients, when I tried to get him to buy more, to buy some, because he was terrified. He just said, "Oh no, it's going to go down some more." And I just, okay, that's you decide. And then later on, it's a cute story. Later on, because his wife, we invested some of her money, most of her money into long-term stocks. He was not happy because she was doing better than he was. Emotions rule us. And then notice it's been bouncing along. Again, 2013, the yield on bonds went above the yield. I'm sorry, the yield on stocks went above the yield on bonds. 2013 was a banner year. Same thing happened in 2023, was it? Yeah. So now we see bond, 2021, when the stock market went up 27%, and the bonds were paying very little because of COVID. But now we see a return to more normalcy for the bond market. In fact, that's what when I listen to people who are very good bond people I trust who know the bond market, say, yeah, bonds are back. They're back. They're not paying fabulously, but they're also paying a lot better than they did since the Great Recession. But notice that stocks are still paying a lot less than they did back in 1960 in terms of dividends. Well, we talked about that in the previous slide. And is that going to come back? I don't know. But I'm a big dividend fan, so I certainly do look for stocks that pay healthy dividends. And we'll see that 2-3% is pretty healthy these days. Some are paying a lot more. Cool? Okay, so ruminate on the relationship of the yield on bonds, which are much less volatile, with the dividend yield on stocks, which are far more volatile. The pendulum swings, slide number 9. The bear markets of 2000 to 2002 and 2008 changed investors' perceptions about bonds. We now see investors and companies focusing more and more attention on dividends. Many companies that never paid dividends in the past are doing so now. Many tech companies are no longer growth stocks. They're mature industries. Some of them, like Microsoft, for example, have been some of the best dividend growers over the last 10, 12, 20 years or so. They started 2003 paying dividends. Also, the tax laws changed the dividends so that they are now taxed roughly the same as capital gains. Now, this is a great line. It's also the name of a book written by Geraldine Weiss, Dividends Don't Lie. The book's not that great. She was actually based here in La Jolla. And who took over her business, she had a investment advisory business. He made another book, basically the same book, called Dividends Still Don't Lie. But I love this line, Dividends Don't Lie. And that book is don't read it. But you can read it. I mean, it's in the library. Go get it. But it's true. Dividends don't lie. The one number that we're going to look at all these different numbers about stocks, but the one number we know is not a lie. They could say, "Oh yeah, we made $500 million." You don't know that that's true. You just don't know unless you're in the company working in the finance department. But the one number you know is the truth is the dividend, because they sent you a check. Well, they don't send a check anymore. It's all electronic. But that's why I love that line. Dividends don't lie. And then this quote is attributed to John D. Rockefeller. We don't know that he actually said it. His neighbors said he said it. Do you know the only thing that gives me pleasure? It's to see my dividends coming in. And I feel it's not the only thing that gives me pleasure, but I certainly do love dividends. Dividends don't lie. It's money in your pocket. Slide number 10. Okay, well, let's diverge into a couple of terms that you should know probably by now just because you're part of the culture. But a bull market is when stocks are going up. A bear market is when stocks are going down. Now, the definition of a bear market is when the stock market has gone down 20%. But some stocks, they go down a lot more. Other stocks don't go down as much. Where do these terms come from? Well, if you're into, is it entomology, I think, or etymology, the origin of words, check it out, because bulls, charge ahead. They throw their opponents up in the air. Bears are more reclusive. They knock their opponents down. But that's not where the bear market came from. It's a little bit trickier than that. And I still don't really understand it as well as I should. But if you're so inclined, take a look at this one little article here from Investopedia, or doing any internet search will give you plenty of materials about it. Where did the terms come from? But no, bull market, stock market's going up. Bear market, stock market's going down 20% or more. If it just goes down 5 or 10 or 15%, that's a correction. It's still gone down. The downturn. Slide number 11. What are the pros and cons of stock ownership? Well, one of the biggest pros, in my humble opinion, is that it allows you to share in the rewards of the business enterprise. This means that if the company is publicly traded, you can be a part of the enterprise. You wear Nike shoes. Maybe you want to buy Nike stock. You go to Home Depot or Walmart or Costco, or you own Apple products. You can join in that enterprise. They've been the best financial investments over time. Now, some people jump up and down and say, oh, real estate's done a lot better. Well, real estate's a whole other world, and we'll discuss real estate at the end of the semester. But in reality, real estate's really hard to teach in a classroom. You really have to get out there and get involved in the industry. But stocks have been the best financial investments, dividends, capital gains. They are easy to buy and sell, which means they are liquid. In other words, somebody wants your shares of Nestle or whatever. We talked about the limited liability, meaning that they can't come after you if the company goes bankrupt. But one thing that we don't think about, which is important in my humble opinion, is that this system, capitalism, has increased the standard of living for everyone around the world. I mean, the statistics are, the COVID really set us back several years. But before COVID, my understanding is, the stuff I've read, is that half of the world's population was above the poverty level for the first time ever. Middle class, they called it. The world middle class. And you can't say the United States middle class because that's not comparing apples to apples. But half of the world's population was at the world middle class level. And that's good, right? We want people to have clean water, food, clothing, shelter. And as I said, COVID set us back a bunch, but we're striving to increase the standard of living for all. Now, what are the downsides? Well, as we said, the stocks are risky. Stocks it doesn't go up in a straight line, folks. Stocks are volatile. I hope you saw that with chapter 2 when you saw the illustrations. Yeah. Stocks are volatile, which is the industry's popular euphemism for, oh my gosh, I lost a lot of money. But as we said, we said it in chapter 2 when we were discussing mutual funds, we can use volatility to our advantage. Assuming we have enough time, we can continue to buy shares even when the price goes down, and our average price per share should be less. Average cost per share should be less than our average price per share, but it's not a guarantee. And then there's all kinds of corporate and financial industry hanky-panky. Yeah, because that's where the money is. But in general, I teach this stuff, right? I'm a stockbroker. I've been investing for years, thanks to some people who steered me in the right direction. I'm very optimistic. Capitalism, as we said, it might be the worst economic system ever devised, except for all the others. And you notice that many people, many countries around the world are saying, yeah, we think it's a good idea, and we're gonna do our best to emulate the West's model, which it started in the West, but we're gonna do our own little take on it sometimes, like China, which is, we thought 20 some odd years ago when they entered the World Trade Organization that they would liberalize, and oh my God, we use those words liberal and conservative at our danger because people hate those words now. But it hasn't happened. They've kept a very tight grip on the political landscape, but economically they're doing pretty darn good. And India is doing better. Africa's booming. Latin America, Eastern Europe. I'm very optimistic. Okay, I'll stop. Sounds like an advertisement. My apologies. Slide number 12, our last slide. Now, volatility examined. This is the kind of graph you'll often see. It shows from a certain starting point, in this case $10,000, and then where it ends up. But this is the S&P 500 for year 2023, which is actually a pretty good year. 2023 was actually a pretty good year. So far, 2024 has been a pretty decent year, volatile, which is what we expect. And so you, January 1st, put $10,000 into the stock market and saw it go up almost 10%. And oh my goodness, aren't you feeling so proud of yourself? And then it went down 10%. Oh my God. Okay, I got to get out now. So you get out now, and then it goes up 10%. And you go, oh no, I'm not going to get fooled. Then it goes up another 10%. And then okay, all right, I'll put it back in. And then it drops 10, 12%, 14%. And you take it out and you go, I'm never going to do that again. And then it jumps over to almost 20%. Oh my goodness. You see what volatility can do if we don't take a long-term perspective. In other words, if we put the money in $10,000, and I don't know why we use 10,000. That's what the Securities and Exchange Commission asks us to use, so we use 10,000. Put $10,000 January 1st, 2024, and then 2023, and then went to a deserted island and didn't have internet, didn't have newspapers or television or whatever, and just let it sit for an entire year, come back, and we did pretty darn good. Our $10,000 became over $12,000. So, you see, that's the big con. That's the big downside to stock investing. Our emotions, because we hate to lose money. We absolutely hate it. It's more painful to lose than the joy we get from gaining. And so, as we've said, we're going to do our best to help you deal with those emotions, but ultimately it's your money and you have to decide. Take a long-term perspective and just believe in tomorrow. Be optimistic. All right, enough of that. Thank you so much for being in our class, dear students. We're so proud of you. Go back over, make sure you understand all the material in this presentation. Read the chapter. Contact me if you have any questions. My goodness, I can talk about this stuff far longer. I think you've noticed that. Far longer than any reasonable person could ever want to listen. And so I'm here to help you. We have tutors to help you. We want you to be awesome. We want you to be rich. And remember, there's a future for you in our industry. There's a bunch of us old guys ready to retire or die. And we need more women. We need more minorities, more bilingual, multilingual, and they simply love veterans. So think about it, dear students, and thank you so much for being in our class. See you in our next presentation.